So for technology companies, you guys have wonderful product or technology that can sometimes transform the world. So if you can take advantage of all the tax laws, tax incentives that's available there, uh, you will, um, having a wing, another two wings that can help you fly uh, fast and higher quickly. So one of the great opportunity is called Opportunity Fund for Opportunity Zones. And now this is as this is part of the gift from the 2017 tax law update. Okay, the purpose to be to invest in low-income communities and help the less developed communities to develop. Um, Now the incentives are one is deferral of capital gain tax. So if you sell something today and you owe capital gain, say, if you sell Apple stock or real estate with a capital gain of $1 million, now if you don't do anything, now you have to pay 20% of capital gain tax. That's $200,000, and you only have $800,000 left. But if you can roll over to an opportunity fund, then you can defer this for until April 15, 2027. Okay, and then and if it's more than 5 years, you reduce the gain by 10%. And then if you put the money in there, continue to grow. If you put the money in there for 10 years, over 10 years, the new capital gain, the money you made out of this investment, say, you put $1 million there and then it becomes $3 million. Now the $2 million is completely capital gain tax free. Okay, so that is important. If you have a technology company, you should find some ways to be qualified as an opportunity zone business. Okay, you can open an office there, have some staff there, or do something to qualify. And this will help your investors to have more tax-free gain, and it will help the communities to develop. So put in the timeline, you put the money in there, and so if you're there for 5 years, so now it's 2020. So if say you put money there in 2025, you reduce you firstly defer the tax until then, and then also you pay less, 10% less. So now this one, if you put there for 7 years, then you have another 5% reduction. And then if you put there for 10 years, the new appreciation will not be taxed at all. So does it make a difference? Yeah, if you look at the chart, right? If say you put $1 million there and at 10%, this is how the difference it will make. So basically, the steps is you identify the qualified gain, and then you roll over the capital gain into a qualified opportunity fund within 6 months, and then report rollover on Form 8949, and pay capital gain tax on April 15, 2020, on your 2026 tax return. If you stay in qualified opportunity fund for 10 years, enjoy the new appreciation in QOF tax-free. If you want to start a QOF, you can do it in many ways. A common way is create a Delaware LP with a GP and LP, and we can help you there with that. The rule for QOF is you have to have 90% assets invested in opportunity zone, and it has to be evaluated every 6 months. They're everywhere. This is Los Angeles, where I live here. And if you look at it, Los Angeles is a cosmopolitan area with a lot of high tech. So if you just move to one of these communities, they may not be far away from where you live. You can still work from home, or you can go there once in a while. This is South Bay, Long Beach. So really the idea is you want to learn as many of the great tech strategies as possible. And then you choose the situation, and then you sometimes tailor the situation to your strategy and use several strategies simultaneously. So for example, one of the strategies called qualified small business stock. If you are qualified, no capital gain at all. So it's for C Corp only. And if you acquired the stock after September 27, 2010, original issue with total assets within $50 million after issuing. Okay, that qualifies small business. Okay, and hold for more than 5 years. If you qualify, the greater of 10 million or 10 times your base is capital gain tax-free. So this is qualified equity grant for private companies. You can defer income for up to 5 years for income tax. And the criteria to qualify, it has to be a compensation for services and safe harbor. Now, these are really the pre kind of before the employee stock ownership plan, okay, the ESOP. So I would say these are superseded by the ESOP. If you can start an ESOP, these are, you don't need to consider these. These can be built into your ESOP because the ESOP has overall more comprehensive and more even better tax incentives. So this one, if you're a technology company, you really want to approach to that. It's called America's Cedar Fund, funded by the National Science Foundation. You can, phase one, you get a $225,000 fund to develop your technology, and then phase two, $750,000. And after that, you can still get a 50 cents to $1 match up to $500,000 private funding or revenue. And then you will also apply for the research and development tax credit, which gives you 20% of qualified expenses up to $250,000. Now this, I tell people, again, we use a strategic and proactive and systematic approach. So if we plan that we will have some projects or research and development projects, we plan this way and we code it into our accounting system. And then when the transactions happen, we book it under this project. And so at the end of the year, we know these qualify for research and tax development tax credit. Okay, so we want to do it proactively. That's the cheapest way and most easier way. So this, we talked about that. So really this came to this, my favorite employee stock ownership plan. Now, employee stock ownership plan, it is like a qualified retirement plan. It's just like a 401k plan. So the employer's contribution is tax-free. The employee's contribution is also tax-free. And it grows tax-free inside there. And the good thing is it is a trust. So the trust is a separate entity. So that usually you can leverage this. So that means the company actually can borrow money for these stocks that are going to be purchased by the ESOP plan. Okay, so this way you kind of creating your own IPO, right, for your employees. So this one, you really is a tax shelter plus financing source. It's a financing vehicle. And it's also an exit strategy for owners and a succession plan. And even better, the seller of C Corporate can defer gain by reinvesting to a similar or like kind of asset if your company is owned by your ESOP for at least 30%. So this is about stock option, how you pay tax. Again, this can be built in within the ESOP plan. So for stock options, basically you're paying two tax. One is when it's exercised, that is just as if you pay the salary. So it's ordinary income. And then another is when the stock is sold. That's capital gain tax. So if we look at this, you have $1 when you grant, but when you exercise, it's $5. So you have to pay tax for the $4, okay, as if company paid you $4. So that's in. And then when your price grows to $10 and then you sell it at that time, so you pay capital gain tax for the $5 increase. So that is how it works. On the other hand, if you hold it for more than 2 years, if you grant and then in 1 year you exercise but you don't sell it, you hold it for another year, all your income, including the ordinary income and the capital gain, are taxed at the long-term capital gain tax rate. So, but if you sold it within 1 year, and if you have good luck and go IPO within 1 year, everything is taxed at ordinary income. Okay. So I think with that, I want to say thank you. And this is how you can really spend your thinking. Really, a lot of the freedom is there. If you plan well, you can save a lot of tax and gain a lot of wealth, create a lot of wealth. Okay, thank you. And then we'll talk another video.